Hey everyone, and welcome to This Explainer. I am absolutely thrilled to have you here today. We are going to be decoding the fast-paced, seriously high-stakes world of modern trading strategies. If you've ever wondered exactly how the pros navigate those crazy, chaotic ups and downs of the financial markets, well, you are in exactly the right place. We're going to completely strip away all that confusing jargon and break down the absolute core mechanics of how modern trading actually works.
So, I want you to picture this. Imagine a massive, lightning-fast global auction house. But we're not talking about your typical auction for, say, vintage cars or rare art. Instead, you've got people rapidly bidding on fractional shares of companies, on currencies, and on commodities. Think about traditional investing for a second. It's kind of like planting a tiny seed and patiently watching it grow into a massive tree over a couple of decades. But trading? Trading is a completely different beast. It is hyperactive, it's fast, and it's laser-focused on capturing those super short-term price movements to turn a quick profit. All right, so here is our roadmap for today. We're going to cover 1. How traders make money. 2. The 4 trading styles. 3. Reading the market. 4. Advanced frameworks. 5. Leverage and risk. And finally, 6. The golden rules.
Let's dive right into Section 1. How traders make money. Profiting from market volatility.
The truly unique thing about traders is that they profit from how fast and how wide a price moves. Honestly, a lot of times, they don't even care about the actual direction. It all boils down to 2 core strategies. First is going long, which is your classic traditional method, right? You buy an asset when it's low, and you sell it later when it's high. Simple. But going short, that's where things get pretty clever. If a trader is betting that a price is going to drop, they actually borrow the asset from their broker, sell it immediately at that high price, and just wait. Once the price plummets like they predicted, they buy it back at the new dirt cheap price, return it to the broker, and simply pocket the difference.
Moving right along to Section 2, the 4 trading styles, finding your perfect time frame. What's really fascinating here is that traders absolutely do not all operate at the same speed. On the extremely fast end, we've got the scalpers. Operating in literally seconds and minutes, they are rapidly executing hundreds of trades a day just to capture tiny fractions of a cent. Stepping back a bit to the hourly time frame, you have day traders doing that daily hustle from the morning bell right to the afternoon close. Then, slowing things down, swing traders operate over days and weeks to capture those broader momentum trends. And finally, position traders drop the pace completely, patiently holding on to trades for months or even years to ride out massive macroeconomic shifts.
Now, for those speed demons, the scalpers and day traders, there is a super strict boundary. Absolutely no overnight holds. See, they want to avoid the terrifying risk of unexpected bad news. Imagine an after-hours earnings report dropping and completely crashing a stock before the morning bell even rings. So to dodge that, they close every single trade before the day ends. They go to bed totally flat. Contrast that entirely with the wave-riding swing traders and the big-picture position traders. They intentionally absorb that overnight risk because, well, they're chasing much larger, far more lucrative trends. They just tune out all that minute-to-minute noise and keep their eyes firmly fixed on the ultimate long-term destination of the asset. Okay, Section 3, reading the market, technical versus fundamental analysis. So how do they act like detectives and figure out the exact right moment to buy or sell? Well, they generally fall into one of 2 camps. First up, we have the technical analysts, the pulse readers of the market. This is the belief that literally everything you need to know about an asset is completely baked into its price and volume history. They genuinely do not care what a company actually sells. They just study the data patterns to predict future momentum. And their toolkit is incredibly specialized. They use these things called candlestick charts to track the open, close, high, and low of a specific time frame. They expertly bounce trades between support, which is basically a psychological price floor, and resistance, a psychological ceiling. And to confirm these trends, they use mathematical formulas and indicators, like the Relative Strength Index, or RSI, to mathematically signal if an asset is being overbought or oversold. Then on the flip side, we have fundamental analysis. This is all about evaluating the actual real-world forces that drive an asset's true intrinsic value. These traders are looking at stark reality. If their financial models tell them a stock is intrinsically worth $100, but Wall Street is currently pricing it at 70, they're going to buy it. But here's the catch. The specific data you analyze completely changes depending on what you're actually trading. A stock trader is going to dig deep into corporate earnings reports, profit margins, and executive leadership. But a Forex or currency trader? They have to zoom way, way out. They're looking at massive, countrywide data like inflation rates, unemployment, and central bank interest rates to figure out the actual strength of a nation's money. Let's level up. Section 4. Advanced Frameworks. Specialized techniques in modern markets.
In today's markets, you've got these highly specialized players dominating the board. First, the momentum traders. These are your ultimate trend writers. Their whole motto is buy high, sell higher, as they aggressively hop right onto the bandwagon of skyrocketing volume. Contrarians, though, they do the exact opposite. They are the incredibly brave folks stepping right into the panic, buying up assets when the rest of the crowd is completely terrified, just banking on an inevitable mathematical rebound. And then, there are the quants. These are algorithmic software bots scanning for tiny anomalies and executing thousands of trades in milliseconds, totally devoid of any human emotion.
Which brings us to the absolutely critical Section 5. Leverage and risk, the essential operational levers. To survive out there, you absolutely must understand amplified buying power. Say you only have $1,000 in your account. If you borrow from your broker using 10-to-1 leverage, you suddenly have the power to control $10,000 worth of stock. It's a massive boost. But listen to me, leverage is a truly terrifying double-edged sword. If you use that 10-to-1 leverage and the stock goes up by just 5%, your original $1,000 account grows by a massive 50%. But if that stock drops by just 10%, you lose $1,000. Your entire account is instantly vaporized in a margin call. Leverage multiplies your wins, sure, but it violently accelerates your losses. Because of that immense danger, professional traders rely heavily on these ultimate automated safety shields. Step 1, they set a stop-loss order. If the market suddenly takes a nosedive, the broker automatically sells the position, capping the downside before it turns into a total disaster. Step 2, they set a take-profit order. The exact second a stock hits their target price, the system automatically cashes them out, brilliantly locking in those hard-earned gains before the market ever has a chance to turn around. Let's wrap this up with Section 6, Golden Rules, Mind over Math for New Traders. Look, at the end of the day, trading is a mental game far more than it is a mathematical one. First rule, leave your emotions at the door. Greed is what makes you hold winning trades until they crash, and fear is what makes you panic sell perfectly good setups way too early. Second, you gotta start with paper trading. Use live simulators to thoroughly test your strategies completely risk-free before you ever touch real capital. And third, treat this exactly like a real business. Keep a detailed trading journal. Reviewing your hard data is really the only way to actually improve. Which leaves us with one final, deeply critical question. When you decide to finally step into this massive, high-speed global auction house, are you actually leaving your emotions at the door? It's the one thing you absolutely have to master before you ever click that button to execute your very first trade. Thank you so much for joining me on this explainer, and hey, keep learning.